Say welcome to everyone. It's great to see you all along today. For those who don't know me, my name is Ashley Shield. I'm one of the executive directors of Jonge, and today we have Phil Homenko again speaking with me, who is our National Compliance Manager. For those of you who have attended before, you would know that normally Phil puts me in the hot seat and I have to answer all the questions that he's wrapped up and got organised for me. But we're going to have a little bit of change of tack this time because I got sick of being targeted by him, and it's we're going to put the pressure on Phil today. So we're going to be running through a case study from a few years ago and talking through some of the danger points and some of the things to be aware of from that. So I'm looking forward to putting it on you today, Phil.
Yes, Ash, my turn in the hot seat, mate. I bet you've been looking forward to this one.
You got to have your fun, don't we, mate?
Yeah. Now, before we kick off this morning, Ashley, are there any industry updates or any news that is topical that our audience might be interested in?
Yeah, a couple of things that we'll just run through. One is that you may have seen in the press leading up to the new budget that's coming out in 9 days now, that there has been a lot of talk about some further insolvency reform. We saw earlier in the year that they released some new reforms, and now they're talking about extending those reforms and taking them a step further to include things like trusts, schemes of arrangements, and a number of other areas. But I want to make it clear that it's not going to be rushed through this time like it was with the December legislation. The big announcement is that they want it looked at and there will be consultation. So as a normal rule, we would anticipate when you start including consultation, you're 4 or 6 months away before having any real legislation to talk about. But again, for everyone here in the room, we are keeping a very close eye on it, and particularly looking at it in how it can be used to any changes and how that actually helps the directors and your clients. So when we know more, we'll let you know, but it's certainly not something that we need to think of as something that's going to be an urgent change like we saw through COVID. The other thing is that it's become quite clear, and some of the Assistant Deputy Commissioners have been talking about that the ATO has started their collection. They've turned back on penalties and late lodgements and all that sort of stuff. And again, most of our listeners would be aware of that. They have been pretty clear that they're selectively going to start targeting and going after people now. So part of that selection, we believe, is going to be focused around those who had pre-COVID tax debt that they still haven't dealt with. But for most people who have clients with any type of tax debt, be a little bit aware that it's certainly game on, even if the gloves are still slightly on at the moment. So that's they're basically the updates, and again, for those who are new for us today, we'll each month we'll make sure that we keep you up to date with any changes that are happening. So Phil, it's your turn, buddy. It's time to put you in the hot seat. So if we're going to, as I mentioned, we're going to be doing a little bit of a case study style. So what to be able, we need to put some framework around the case study. So why don't you give us a little bit of a background on the matter that we're going to be talking through today?
Yeah, sure, Ash. Well, today we're talking about a former Jonge client from a few years ago. His name was Justin, and he worked for many years as a subcontractor to a larger company. Now, Justin was on very good terms with the owner, who was Henry, and he considered him very much a friend and a business mentor that he relied on and that he trusted very much. Now, Henry's business was servicing the production lines on major Australian companies, and by that I mean major corporates, ASX 200 type companies, and he did all the production line servicing on a subcontract basis. Now, Henry was looking to retire, and he offered Justin the opportunity to buy the business. Now, what Henry wanted was for Justin to buy the shares in the business because that just suited his own retirement planning and his own tax planning. Now, Justin raised as much money as he could towards the purchase, and he did a redraw in his family home and borrowed as much money as he could against his own assets, and he was able to raise $500,000. The total purchase price was $1.5 million, and Henry funded the balance of that, being $1 million under a vendor finance agreement. Henry's solicitor prepared the sales agreement. Henry's accountant provided all the goodwill valuations, and a valuer that Henry had worked with for many years provided all the equipment, the plant and equipment valuations. So before too long, Justin was running a very large company. Henry retired as a director, and Justin was appointed as the director and shareholder of that business.
It sounds a little bit like, Phil, it's a little bit of this succession planning and moving, the young gun through into the next phase and allowing someone to start going through that succession and retirement phase.
Absolutely.
So what happened after all that transaction occurred?
Well, Justin took over running the business, and the business traded very well. Now, at Henry's request, Justin made accelerated payments off the vendor finance loan because, again, that suited Henry's retirement plan. And over the space of around 12 months, Justin was able to repay $400,000 off that loan. However, as a result of accelerating the payments on the vendor finance loan, Justin got behind on his statutory obligations and his payments to the ATO. But he thought, look, no problem, the business is trading well, I'll just get a payment plan with the ATO, so it's no big deal. Now, Justin was required to provide certain information to the ATO for them to consider the payment plan, and they were things like cash flow forecasts and aged debtor listings. Now, roughly around the same time, around 12 months after Justin started running the business, he became aware that there'd been a workplace accident prior to him becoming a director, and it was a workplace accident interstate where several employees were seriously injured in an accident at a job site where they were servicing a production line. As a result of that, the company faced very significant claims, and importantly, its work cover premiums just went through the roof. After that, so Justin's now dealing with those problems, and it turns out that the ATO didn't approve that payment plan. They actually rejected his request. Now, at the time, Justin was unaware that the company actually had a very poor history of compliance and payment with the ATO. They'd been in arrears on numerous occasions, and had actually been threatened with legal action before Henry affected payment to the ATO. Now, when the ATO rejected the payment plan, not only did they not approve to enter into a payment plan, they actually issued a Garnishee Notice on Justin's largest client, which was a very big Australian corporate client. Now, the corporate client fully understood what a Garnishee Notice meant and understood that Justin must be behind with his ATO. And they had a word to him and advised him that they were going to put the service contract out for tender. Now, that's something that they've not done in many, many years. They went further, though. They said to Justin, look, we're putting the contract out to tender, and you're welcome to submit a tender if you wish, but we really don't want you to waste your time.
And we'll go into a bit more detail about Garnishee Notices, but they can have a really significant impact on people's businesses when the ATO uses the debtor garnishee process. So it sounds like all of a sudden Justin, who thought he was taking over the world and growing a big business, got into a few problems. So how did it all end up, mate?
Well, Justin realised that he had problems, he had claims, he had issues with the ATO. So what he wanted to do was to restructure the business. And that means selling the plant and equipment and the goodwill to a new entity and trading in the name of a new company. The problem he had, though, was that Henry had secured his vendor finance loan with a security interest over the company. That's called an ALLPAP, and it stands for all present and after acquired property. So that means that Henry would need to agree to any restructure. With the loss of a major client, the other thing that happened was that the goodwill value of the business actually collapsed. So rather than being worth what it was 12 months prior when he bought it, the business was now only valued at $500,000. Now, at that time, Justin still owed Henry $600,000. Ultimately, Henry enforced his security over the company and used that security to effectively take control. What Henry did then was that he did the restructure, and the business did start trading in the name of a new entity, but that entity was under the direction of Henry's nephew, a guy called Alex. Now that left Justin with a pretty big home loan debt and no source of income to be able to pay his bills. So a really bad outcome for Justin.
A terrible outcome. He spent 1.1 million buying a business that was taken off him by the person that he thought was his mentor to start with.
That's right.
Yeah, really, really horrible things. And I think, and obviously a big part of what we want to talk about today and break down and go into some of the details is particularly around this use of share purchases to transfer businesses. I think, it's pretty clear there that you're not a fan of them. And I think that there's a whole lot of risk that can be hidden inside the shell that you're buying. So, do you want to talk a little bit about, some of what could be done a little bit differently?
Sure. Well, as you say, Ashley, there are very significant risks in buying the shares in an existing company. Now, Justin's option would have been to buy the business rather than the company. So have the plant and equipment and the goodwill valued and buy it in the name of a new entity, effect payment back to Henry's company, and then Henry can make his own retirement plans. So a lot of these things were done, at Henry's direction, and Justin trusted him and wanted to cooperate and did it the way that Henry wanted. But a clear option would have been to buy the business rather than buy the shares.
So, and what are some of the pitfalls of buying shares? I think you mentioned that he found out that there was a work cover issue that was hidden in there.
Yeah.
Now, he had worked in the business, but obviously he wasn't aware of that going on.
No.
But, coming through as that mentor, he'd taken a lot of, obviously, belief that what was going on in the business was correct.
That's right. And the problem with buying shares in a company is effectively that you just don't know what you don't know. And while Justin knew Henry very well and had worked as a subcontractor there for many years, he wasn't involved in the day-to-day management or administration of the company. So the problems that you can have there are significant risks. We understand that sometimes it's done, but you can face a number of claims. And that can be anything from the injury type claims that Justin faced, right through to product defect liability and other forms of commercial litigation. Another issue to consider is directors' penalty notices. Now, this is not only an issue for someone that's buying shares in the company, but also an issue for anyone that is going to be appointed as a new director of a company. Now, under director's penalty notice, the ATO can hold the director liable for unpaid PAYG, superannuation and GST. And that liability applies whether they were director at the time that the liability was incurred or not. Now, effectively, a new director has a 30-day due diligence period. So they've got 30 days to get in there and have a look at the books and records of the company and satisfy themselves that everything's okay. So for new directors, if they remain in place in a company for greater than 30 days, they can inherit any liability under a director's penalty notice that may exist, whether they are a director at the time or not. There are two types of director's penalty notices, and you and I talk about this all the time, Ash, but there's effectively a lockdown director's penalty, what we call a lockdown director's penalty notice, and a non-lockdown director's penalty notice. Now, the difference between the two is whether the liability to the ATO has been reported within the prescribed timeframe or not. Now, we'll firstly talk about non-lockdown penalties, and that applies where everything has been reported within the prescribed timeframes. Now, for PAYG and GST, that must be reported within 3 months of the due date. For superannuation, it must be reported by the due date. Now, if it's all been reported on time but remains unpaid, the director can still get a director's penalty notice, but it's of the non-lockdown variety. And what that means is that the director is able to remit their liability, so that liability can go away. If they do one of three things within 21 days of the date on the director's penalty notice. Now, those three things are pay it, put the company into administration, or put the company into liquidation. If the director takes one of those actions within 21 days of the date of the notice, that liability is remitted. Now, a lockdown director's penalty notice is where those obligations have not been reported within the prescribed timeframes. Now, in that circumstance, the director is unable to remit their liability, even if they put the company into liquidation. So effectively, they need to pay it personally, or they may need to consider bankruptcy to deal with that debt. So in this case, the message is always report those liabilities within the prescribed timeframe, whether the company is able to pay them or not. Now, we know that some directors out there may think the smarter thing to do is not report them, that if I report them, the ATO is going to know I owe them all this money that they currently don't know about, and they might start getting interested in me and they might start chasing me. But by reporting it on time, if things don't go according to plan, at least they have the opportunity to remit their personal liability and let that debt stay with the company.
Yeah, and I think it should be, and most people would be, again, who listen to us regularly, it's something that we harp on a lot about regularly, is that, the lockdown regime was brought in place to give the ATO a sporting chance to chase their own debt, so that they knew what they had to chase. The other thing that you didn't mention, Phil, and in the past it has been an issue, is you used to be able to enter into what they thought well, not what they call it. It is a payment plan, and people thought that you remitted the penalty when you went into a payment plan. Need to be really clear that that is not true, and it does not work, particularly if you don't end up meeting that payment plan. Obviously, if you meet it and you pay it in full, then you paid it, so there's nothing to claim. But payment plans do not get you out of the lockdown or the non-lockdown components. So everyone should be pretty clear on that when they're dealing with their clients. So as I said, we're not fans of share sale agreements for transferring businesses. They have their place, but there are a lot more risks than I think people need to be aware of. So if we're not looking at using a share sale agreement, what would we look at doing, and how would we look at doing it as a better way for clients?
Yeah, well, as I said earlier, we'd look at just buying the business, so not the shares in the company. This means getting the physical assets and the goodwill valued, and paying the commercial amount for it back to Henry's company. Now, in that case, Justin would still be running a big business, but he wouldn't have had the problems with the ATO or with the work cover premiums that he ended up experiencing by taking over those shares.
Mm-hmm. So, and you mentioned in their business valuation. So, in your intro, you talked about the fact that business valuations were done.
Yes.
So why do we have the situation now that we're saying it should be done differently?
Well, in this case, the valuation was done by Henry's accountant and not by somebody that was totally independent. Now, valuations of business goodwill are often done on what are called multipliers. And this refers to a multiple of the recurrent income of the company to determine its goodwill value. So, for example, a valuation of a 2 multiplier would represent 2 years' worth of recurrent income for that business. Now, a very small difference in the multiplier in some cases can have an enormous difference to the actual end goodwill valuation, because you're working in a multiple of income. Now, in this case with Justin, Henry's accountant assessed a multiplier of 3.5 times the recurrent income of that business as the goodwill value. Now, in my view, that's a very optimistic estimate of what that goodwill value should have been, and certainly would have been at the upper end of what you would expect for a business of that nature. And I believe that if an independent valuer had been engaged, you could have ended up with a very different multiplier and a very different end result. So we would say that anyone out there that's considering either purchasing the business or buying the shares in the business really should always get independent valuation, accounting, and legal advice, and never rely solely on the vendor's professional contacts. In this case, Justin effectively used Henry's accountant, Henry's valuer, and Henry's solicitor, and didn't really get that independent advice.
And Phil, I think it would be pretty, I don't think there would be anyone listening into us today that wouldn't look at that and go massive alarm bells just before you even start. So,
Yeah.
but I do know that I've seen it in the past. I mean, in this example we're talking about, Justin was treating Henry as a mentor.
Yeah.
So Justin assumed that he would do nothing but the right thing by him. And that the business can be ruthless, and Henry's accountant's job was to look after Henry, not after Justin.
Yeah.
So it is something that we need when we have any clients come to us, and we've had a couple of cases where they've come and they're going, "Oh, let's just do what he says," and you've had to go, "No, hold on, it's not smart." So. But again, I think everyone knows it, but it's a really clear point. You can see how badly it can turn out.
Yeah.
So given that Justin didn't get any independent advice, what issues do you think would have been found if he got the independent advice that he should have got, and how might that have changed things a little bit?
Well, I think lots. I think there are lots of issues that could have been managed differently if he did get that independent advice. And the other thing to remember is that Justin worked as a subcontractor. Henry was a very experienced businessman, and Justin was probably, much less experienced in those types of matters than Henry was. So one thing that could have been done differently was building in the sales contract the way that was done. Now, it's not uncommon with business transactions that a lot of sale prices are subject to what are referred to as workout clauses or earn-out clauses. And for example, that can be around the retention of contracts, the retention of clients, that type of thing. In this case, Justin agreed to pay the whole $1.5 million for the business with no sort of ability to adjust the purchase price if he was to lose a contract or if something wasn't to perform the way that it had performed in the past. In this case, when Justin lost that major corporate client, the goodwill value of the business was slashed. It's just a massive deterioration. But he still had to pay Henry the full amount that he agreed to pay. Another issue to consider was the vendor finance terms and the repayment terms. Now, in this case, it was pretty vague in the contract. It was just said that he owed him this money, and there was no real set repayment schedule for when those payments were due or how much they had to be. And Henry was able to convince Justin to pay that off pretty quickly. So in 12 months, he got $400,000 of his vendor finance back. Now, if that had been contracted with set repayments and set dates, Justin's cash flow probably would have been a lot more manageable than it ended up being. And he probably would have been able to manage his situation with the ATO a lot better than he actually did. The other thing that strikes me about it was that there was no real obligations on Henry to do anything or disclose anything. So if there'd been sufficient warranties in there, it may have created a situation where the failure to disclose the workplace accident and the impact of that may have given Justin some ability to defend, a demand for the vendor finance loan. But as it was, the contract was written very much in Henry's favour because he got advice and Justin didn't.
And that's good on Henry, I guess, in some respects. So, he ended up having a double dip at all of this. So,
yeah.
We'll move on a little bit from the actual transaction now and talk a little about, again, you mentioned that Justin needed to go into a payment plan because with the ATO. So let's talk a little bit what happened there.
All right. The first problem that Justin had was that he was totally unaware of the company's repayment history or compliance history with the ATO. Now, getting a payment plan is pretty common. We understand that it happens all the time. And the ATO will often ask for financial information for them to be able to consider that payment plan request. Now, the ATO can have concerns about whether any payment that they receive under the payment plan may later on be deemed to be preferential if the taxpayer was to experience an event of insolvency.
Phil, I'm just going to stop you there. You just want to, let's talk about preferential as something that comes up regularly. Yep. People are always worried about preference claims, but there's still a little bit of mystique around what a preferential payment actually is. So do you want to just expand on that a bit?
Sure. Well, the issue is when companies go into liquidation, that if preference payments can be claimed by a liquidator. Now, what it really means is that you've agreed to pay one creditor, like an unsecured creditor, in preference to another unsecured creditor. So we often see, Ash, you and I see that a lot of business owners want to pay their trade creditors and maybe defer those payments to the ATO. So effectively, they prefer their trade creditor to the ATO. Now, for unrelated parties, if a company goes into liquidation, the liquidator is able to demand repayment of any preference payment that was received by a creditor within the 6 months prior to the date of liquidation. And his role is to gather up all that money and distribute it equally, distribute it proportionally, so not preferring one creditor over another. Just as a matter of interest, if it's a related party, that period isn't 6 months, it's 4 years. So I think you and I also see that sometimes the business owner might want to pay back a family member who's lent the company some money in preference to other creditors. Now, for unrelated parties, a really good defence to a preference payment claim is that you took the money in good faith. It's just the normal course of business. You had no reason to believe that you were being paid in preference to another creditor. So fair play, I just took the money that was offered and I didn't know that I was getting paid in preference. Now, in those cases, the actual history of communication between the debtor and the creditor is important. So if the liquidator gets in there and he gets access to the company emails and he gets access to the company's books and records, and he sees that a creditor's been sending, nasty emails demanding payment and threatening legal action and jumping up and down, and then he got paid, it's very hard for that creditor to argue that he didn't have reason to believe that he was being paid in preference to other creditors. Now, for the ATO, that's even harder, because the ATO, if they're entering into a payment plan, well, they know full well that the business isn't paying all its debts as and when they fall due, because they hadn't paid the ATO. And being the ATO, there's a greater level of sophistication for them as a creditor, and it's very hard for them to argue that they took the money in good faith, and very hard for them to mount that defence. And I know you and I, Ash, I've spoken to many liquidators, and one of the first questions they ask me is about what payments have been made to the ATO in recent times.
Yeah. So for the sharp people here, Phil, they would probably know that if they used the new legislation and the simplified liquidation, then the preference payment term is actually only 3 months. So
yeah, good point.
There's an extra bonus point for anyone who picked that up.
Extra credit for that one for sure. And the numbers are all different as well around the thresholds and so on.
Yeah. So I think the ATO, obviously, they've got better reporting systems. So one of the first things that liquidators do when a company goes into liquidation is they get a record of the under freedom of information, the whole file of the company, so that they can actually see how many times the ATO has been chasing money.
Yep.
So the ATO in payment plan scenarios are really looking to try and satisfy themselves that they can argue that they believe, based on the information that they had, that the company was solvent. And I guess that's the key to all this extra information that they're looking at.
Absolutely, Ash. They want to satisfy themselves that any payments that they may receive under a payment plan are not going to be clawed back later on by a liquidator as a preference payment. Now, in negotiating payment plans with the ATO, we understand that it's necessary to give the ATO some information if they request it. Otherwise, they're just not going to agree to the plan. But the problem can be that, firstly, if a business does need to negotiate a payment plan with the ATO, it can be a warning sign that that business does have a few issues and may well need specialist advice from someone like us or from another advisor like an accountant or whatever. Often the ATO debt is just the tip of the iceberg when it comes to cash flow issues or creditor pressures that business may be feeling. It's important to note that when you do provide information to the ATO for them to consider a payment plan, that the ATO is then able to use that information as part of their overall recovery process. That once you hand it over, well, now they know, and they can use that information as part of their debt collection and debt management process.
And I think that's a really important point. We can't deny the ATO has a right to ask for the information, and we can't not give it to them. But how you give it to them, I think, can be a little bit careful, and you can be a little bit careful. And ideally, one of the things that the ATO always asks for is accounts receivable list. And we'll talk about what they do with that accounts receivable list in a minute. But you do have the ability to provide that report, but block out the customers, the names, because the ATO can, if they decline the payment plan, you've then given them who they can target for Garnishee notices.
Yeah.
So providing the information is one thing. Providing it with a level of protection for your clients is certainly the next thing that I'd consider you need to do. So again, in this case, we had Justin dealt with the Garnishee notice. So let's talk a little bit about that, mate.
Sure. So the first thing I'll say about Garnishee notices is that amounts that the ATO recover under a Garnishee notice are not subject to preference payment claims by a liquidator. That's why they do it. It's a statutory right of the ATO. They're able to do it under the law, and the liquidator cannot make a claim for any money that they get from a Garnishee notice. Now, most people know that the ATO can garnishee bank accounts, and commonly they'll know which bank to send the Garnishee notice to by the account number that the taxpayer puts on their BAS for any refunds. So they know where they bank. They know who to send the notice to, whether it's NAB or Westpac or whomever. Sometimes the ATO, we've seen them, that they've issued a Garnishee notice to every bank in Australia, but that's pretty uncommon. Generally, they issue the Garnishee notice to the bank that's recorded on the client's BAS. Now, probably what's a little less well known is that they can also issue Garnishee notices to debtors or to any other party that owes that taxpayer money. Now, Garnishee notices come in two different types, basically. We refer to them as a one-off or as a continuing. Now, a one-off may say something like, if it's sent to a bank, it may say something like, send me 30% of the credit balance of that account, or this amount of money, being the amount that the taxpayer owes, whichever is the lesser. Now, once the bank deals with that notice on that one day, once that's done, the Garnishee notice fails to have any further effect. So they send the 30% or the amount that's requested under the Garnishee, and then that Garnishee notice lapses. Now, the second type is a continuing notice, and that might say to a bank or to a debtor, send me everything that you owe that taxpayer over the next 3 months, for example. So in the case of a bank, that would mean any credit to that bank account, instead of being put to the bank account, would be sent to the ATO for a period of 3 months. And we call those a continuing notice. Same thing happens with debtors. They can say, pay me everything, or pay the ATO everything that you owe that creditor for the next 3 months. Don't give the money to him, give the money to me.
I think garnishees can be very harsh and certainly create a number of issues for businesses. I think, on top of what you've talked about, I've also seen them garnishee FPOS facilities.
Yes, that's true.
And so the ATO, when they want to get aggressive, can use this Garnishee notice very, very effectively for their benefit. But it is very harsh on the business, and it obviously had that effect on Justin as well.
In Justin's case, it was absolutely devastating, And let's face it, businesses out there rely on debtor collections to be able to fund their operations, to pay their own bills and to pay wages. And when a big debtor gets garnished, it can just absolutely cripple that business's cash flow. Now, in this case study, it was some time ago, and you and I might disagree about this, Ash, but in the current environment, I'm not sure that the ATO are going to be overly aggressive with garnishing notices, but it's certainly within their power, and they have the right to do it, and they may well do it, particularly, as you said earlier, when the taxpayer's got a poor history of compliance and maybe had a heap of pre-COVID tax debt as well. Now, in Justin's case, not only did the Garnishee notice cripple his cash flow, it destroyed his relationship with a major Australian corporate that was his largest client. Now, I'm not going to say the name of the corporate, but if I did, I'm sure that everyone in our audience today would recognise the name. and it just ruined his relationship with them. Now, Garnishee Notices, as you said earlier, they are harsh. They're a very powerful tool, and they've been subject to a bit of debate in the media and a bit of criticism. Now, the former ombudsman, the small Australian small business and family enterprise ombudsman, Kate Carnell, was particularly outspoken about this. And I believe she actually used the word draconian when describing the ATO's use of garnishee notices.
Yeah, look, I believe that they will be used. Probably it will take a while before they come into play, but they are draconian. They are tough, but
yeah.
And generally, I don't find them used when people are talking to the ATO. So it only comes up with when people are ignoring them and the ATO's run out of patience. So it's a tool I wish I had more access to sometimes, Phil.
It's a tool I'm glad not everybody does have access to, actually.
Absolutely. So moving on again, we'll look at, you talked about that Justin wanted to restructure the business, but he got blocked by that. And it's predominantly because Henry had an all-PAP in place.
Yeah.
Now, I think all PAPs are an interesting thing, and this whole PPSR is an interesting thing that a lot of people just want to ignore a little bit of. It's interesting. I see regularly in our marketplace that accountants go, "Well, that's a legal issue," and the solicitors go, "Well, yeah, but I can't get past the accountant." So we see a lot of clients that just don't get the right understanding on all PAPs. Now, that's a presentation on its own. I don't want to do that, but do you want to just give us a brief rundown, particularly on all PAPs, because they are a particularly powerful tool?
Yeah, don't get me talking on security interests, Ashley. I'll go another 40 minutes, mate.
Yeah, no, you're not allowed to do that.
No, but an all
wrap up,
is,
mate.
Yeah, an all PAP is all present and after acquired property, and it's a security interest over all of the assets and undertakings of the business, including the goodwill of that business. Now, in this case, Justin could not sell the business to anybody else without Henry's consent because Henry had an all PAP. Henry was able to use that all PAP to take control of the business and then do his own restructure. I'll just add here, Ash, that a lot of business owners and family members lend money to companies, and they do not register a security interest for that debt. We often see that the business owner is actually owed more money than the bank, and the bank has a security interest, and the business owner doesn't. And there's absolutely no reason that related parties can't register a security interest over a company. Now, that can be important because I said earlier that if you pay one unsecured creditor in preference to another unsecured creditor, that can be a problem. But secured creditors, like someone that holds an all PAP, actually has a right to be paid in preference to unsecured creditors. And at the very least, someone with an all PAP has a little bit more control and a little bit more power. And if you like, a seat at the table if that company was to get into financial difficulty. As a minimum, it can mean that you can repay mum's loan or dad's loan or whatever, or a loan from the director without facing the problem of it being deemed a preference payment.
Very good, Phil. Thank you very much. We'll leave all PAPs there. So we are getting close to the end of our process. So I guess I'll just wrap up with a couple of just reminding people of a couple of the key points that we really wanted to get out of the message today. And one is that we're clearly not a fan of share purchases, and that I think you need to be very careful of the risks associated with it. But it is a model. Using the pre-pack model that we're talking about with the business restructure, a lot of people see that as something that only happens at an insolvency phase. It doesn't have to be. The business can be completely solvent and can be done, and there's no liquidation in it. But a proper restructure is certainly what we believe is the safest way for an incoming director and shareholder. Always independent advice, and I think it's mindful to note to be careful not to play on both sides of the fence, which we all think that we're trying to do that to save costs, but playing on both sides can be very dangerous. Sales contracts, again, make sure you get the right advice on those when you're doing it. Please be aware of ATO payment plans. I think there's a lot of talk in the marketplace at the moment that payment plans have been relatively easy to get. they're just asking for information and then they're giving it. That information being held by the ATO, if the client gets into further trouble, can be very, very damaging to that client. So please be very careful. If you're not sure what you should or shouldn't give or where the risks may be, you're more than welcome to give us a call and we'll talk you through where we believe some of the areas of concern can be. And look, I think for me, in a very clear sense, if someone's in a payment plan, you need to be, and we've talked about this before, as Phil and I have spoken many times about it, but once you start getting into payment plans, potentially those clients do need a plan B. And we've talked before about, and for new people, we can talk offline about what a plan B is, but finding a plan B for a client in case they can't meet their plan B, can't meet their payment plans, it's important to get that pre-advice. And as most of you would know on here, we provide that independent advice free of charge to a client who may need to look at second options. And we'll continue to say this forever and a day, but take security, or get businesses or get business owners to take security if they lend money to their own company. So that's pretty much our wrap up today. If anyone has any questions, you can start posting them in the post area, or get ready to raise your hand, which we'll do in a minute. And just as we wrap that up, I'll ask you one last time, Phil. You've survived in the hot seat quite well today.
Thank you.
You've done okay. You're almost showing me up in the hot seat, mate.
I don't know about that.
Have you got any final thoughts that you want to throw out to everyone?
Well, I know we're nearly out of time and I don't want to hold people up, but I'd say we've spoken a bit about the risk of someone becoming a director, or like Justin took on the position of director. There's a whole other set of risks for outgoing directors. So they can still get a director's penalty notice whether they've resigned as a director or not. So understanding that and helping your clients deal with that is important. Also, things like personal guarantees. Directors have to personally guarantee debt. And just because they resign doesn't mean that guarantee goes anywhere. So whether you're coming in as a director or going out as a director, it certainly helps to get some independent advice and to understand what risks may be involved. But we could do a whole nother session on that, Ash.
We can. And our lovely marketing lady has put the feedback up. She's getting ready to we're being judged before we've even finished, mate. So
nothing new there.
So that's pretty much it. If there are any questions anyone has, you can, as I say, raise your hand. I hope Elise is watching that, and she'll let me know. She'll let me know if someone's raised a hand, because I can't always see that. Or you can type the questions in there. So once again, thank you everyone for attending our webinar. We really enjoy providing this information and a bit of education and update on things as we can. The support that you give us is fantastic. Next month, we've got a special treat. We've actually got the gentleman by the name of Paul Jantz from the Professional Partners Accounting Network, who's going to come in and talk a little bit about marketing and accounting. He spent 25 years working for and in accounting firms and how to market and develop and grow their businesses. So he's going to come in from a very different tack. We'll leave the insolvency alone for a little while and just try and feed back to you some ways of developing and growing your business. And he's got some very interesting ideas. So it doesn't look like we've got any questions coming through. So on that note, I'll say thank you. Look out for the next webinar invite. As I say, I think it's going to be a very exciting one. And if you have any friends or colleagues, we run this twice today, and Phil and I are back in the show at 1 o'clock. So if you've got anyone in your offices that you think would really like that, they can still register for the afternoon session and come along and have a look. So apart from that, thank you once again. Have a great month, and we'll see you all next month, if not before in person.
Thanks, everyone.
Cheers, everybody.